Well, I was invested in everything. Stocks, mutual funds, you name it. We would get monthly reports. Things were growing. Everything was growing. In the 90s, you could not lose money in the market, even if you were a dumb investor. I mean, it just kept growing and growing and growing.
Economy was doing great. I mean, you had all kinds of gains in the stock market. That was kind of the dot-com era. You really didn't have to pay attention to, you got your statements at the end of every quarter and you were making money.
It was exciting because gradually over time, we would have a day where we would make $7,000 or and as much as $30,000 in a day as it built, and even more.
In 1996, we had doubled our money. We had almost 500,000.
Steve Shulo and Dan Robertson believed they were headed for early retirement the day their portfolio topped $1 million. It was November 11th, 1999.
Oh, that was a very nice day that day, wasn't it?
What happened November 11th?
See, it's when our portfolio went over $1 million. So that was just amazing. It was like, well, yeah, this is how investments work. You invest it and it grows. I mean, that's how I thought about it.
It was a manic Monday in the financial markets.
Stocks plunged.
Traders are standing there watching in amazement. I don't blame them.
But in the spring of 2000, the market collapsed.
A lot of their customers are freaked out.
We did not know. This is our mistake. We didn't know it was a bubble. We just didn't know. Our portfolio had gone all the way down to where it was in 1996, from 1.5 million to 500,000.
460, I think.
All that was gone.
It happened again in 2008, and the people you see here have been sounding the alarm of the looming financial crisis that will dwarf the crash of 2000 and 2008. They are all right. However, they all have information to sell you, but not a solution that solves the problems of average investors. Hello, my name is Livio Nespoli. Unlike most of these people, I have been a licensed broker and registered investment advisor. Essentially, I've been in the investment business about 30 years. More importantly, I'm a stock market researcher and help people make money wisely. My company, InterAnalyst, is an investment research and publishing company that studies market history and the activities of insiders and precisely how they move markets to get rich. Our research uncovered 3 secret truths less than 1% of investors know. Today, you will learn these truths and how they uncovered a secret solution that can build your wealth faster than at any time in history. Best of all, it costs little to nothing and takes less than 5 minutes a month to use. I will teach this solution to you right now. Let me make this clear. The coming financial crisis that everyone is talking about has been set up by massive global insiders to confiscate up to 80% of your wealth. In fact, it will span global markets in scope. It will be financial Armageddon for most investors' retirement accounts in North America, South America, Europe, Russia, China, the Far East, South Africa, Australia, and any other country with a stock market. You are going to learn 3 secret insider truths the global Wall Street elite won't teach you. I will show you how to use these 3 secret truths to make yourself wealthy faster than at any time in history. But if you ignore them, global insiders will confiscate up to 80% of your investment and retirement accounts in the next 5 years. If you're not prepared, you're going to wake up in 5 years virtually broke. I have been in this business 30 years and am telling you that this is a setup of global proportions and you won't even know what hit you. What will your spouse think? What about your kids? What about your plans? What you will know for certain is that you'll spend years of your life trying to rebuild family wealth and security. That is, unless you are prepared. Fortunately, You will be prepared in less than a few minutes from now. We researched the market all the way back to 1927, over 80 years of data, and uncovered knowledge global insiders use to build wealth. I promise that anyone can learn, apply, and afford the techniques these insiders use. I want you to know that there are people out there a heck of a lot smarter than me. So I hope you don't mind if I use them to help me tell you what is going on. In fact, here is one of them. His name is William J. O'Neill. He is the founder of Investors Business Daily. And he says, 90% of the people in the stock market, professionals and amateurs alike, simply haven't done enough homework. As you will see, he could not have been more accurate. When I started my investment career as a rookie broker in August of 1985, I was as green as the Nebraska prairie. My goal was simply to provide clients with the best investments available. I was trained by the investment industry to be a good little stockbroker. I was taught to sell mutual funds and stocks in a diversified format and have my clients hold them forever and ever. But by 1988, I was frustrated. You see, I was making great commissions, but client accounts were growing slowly. In fact, their returns were dismal. I was having a real crisis of conscience. You see, I was making plenty of money, yet my clients were barely making anything. Although I have certainly changed, this is still going on out there, and nothing has changed in the advisory business in 30 years. That's what's really sneaky about this whole system. People like me sell people like you mutual funds, and we're trained to sell you the ones that pay us the most money in management fees and commissions. People like you think you made a great investment, when really what happens may not be crystal clear. Why? Because your advisor will either not tell you or may not even have learned this knowledge yet. Here is a clip from the amazing Frontline documentary, The Retirement Gamble.
Mutual funds rely on brokers and plan administrators. In return, the brokers ask for a payment or revenue share. It's a kind of pay-to-play arrangement, or as some say, a kickback, that adds another layer of costs to retirement plans.
A lot of people use a term like kickback because in some ways it's a legal kickback. There's nothing against the law about it, but it is a sort of you scratch my back, I'll scratch yours kind of arrangement. If you sell our funds, you will get a portion of the revenue we earn from selling them through you.
Look, I was just like your advisor until I did my research and actually grew a conscience, which is a pretty rare occurrence in this industry. I decided I wanted to make myself feel better about my career, justify what I was giving people by at least trying to find something that benefited them as much as me. That's when the light bulb turned on and sparked the research that eventually led to the findings of what you are going to learn right now. My research started with a simple question: which mutual funds consistently beat the S&P 500 index over the long term? Since the S&P 500 index is the benchmark of the investment industry, we wanted to find funds that were better over the long term. Well, the research changed everything. We compared all available funds to the S&P 500 on a 10-year rolling month-to-month basis starting in 1927. January 1927 to January 1937, February 1927 to February 1937, March 1927 to March 1937, and so on. The research uncovered the first secret insider truth the Wall Street elite won't teach you. On a 10-year rolling month-to-month basis, the S&P 500 index outperforms 86% of all mutual funds. Just listen to what Jason Zweig from the Wall Street Journal says about this.
One of the ultimate dirty secrets of the fund industry is that a lot of people who run other fund companies own index funds in their own accounts and don't talk about it unless you put a couple beers in them.
Amazing. Secret truth number 2 is even more powerful than secret truth number 1 and will lead you to wealth even faster. Let's take a look. Dalbar is a company that provides stock market information to researchers like us. They concluded that more than 70% of mutual fund inflows typically follow the previous year's winners, usually based on the Morningstar rating for funds. So what does this mean? It means that most of the money going into a mutual fund goes in the year after the fund ranked in the top 10. This made absolute perfect sense. The public is always late chasing returns. Dalbar also found that only 1 year later the top funds were underperforming the index again. Here you see the top 10 performing funds in 2005. Only 1 year later, most of the top 10 fund performances started their collapse into the thousands. Here's a clip from that same acclaimed Frontline documentary, confirming our research.
Are you getting superior performance? And the answer unequivocally for the industry as a whole is no. There's no scientific evidence that mutual funds outperform a simple strategy of holding the market index.
The evidence is overwhelming. Year after year, actively managed mutual funds fail to beat index funds. Studies have borne this out repeatedly over various time periods, in bull and bear markets.
Well, if only the past were prologue, it would be a great thing. Returns do not persist.
There are some funds that are outperforming the broader market.
The good markets turn to bad markets turn to good markets. So the system is almost rigged against human psychology. High likelihood is when you get to somebody at his peak, he's about to go down to the valley. The last shall be first and the first shall be last.
To validate these facts, we decided to look all the way back to 1998. As you can see, over the long term, the top funds in the first year ranked in the thousands almost 10 years later. This research uncovered the second secret insider truth the Wall Street elite won't teach you. Buy and hold does not work long term. Day trading is for gamblers. Gamblers always lose to the house. The house is run by insiders. Now let's uncover the third and most powerful secret insider truth.
It's one of the products that Americans buy that they don't know it's danger. And it's because the industry, the mutual fund industry, have been able to protect themselves against regulation that would expose the danger and price of their products.
Let's peel back the curtain and reveal the truth. The stock market is simply that, a market. In every market transaction, there are two sides. One side is a person expecting that the price will go up. On the other side is a person betting that the price will go down. And only one group wins, the global Wall Street insiders. Remember, there is always someone on the other side trying to be smarter than you and ultimately take some of your money. Do you really honestly think you're smarter than industry insiders? Because that's who confiscates your money, and you do not even recognize it yet. Let me show you this 100% legal yet sneaky confiscation technique right now. I want you to look at 3 long time frames of complete wealth confiscation. I promise you that the global Wall Street elite will never show you these charts. In fact, they hide them. The first chart covers the Dow Jones starting in 1902. This is a long 19-year period of confiscation. The second chart covers the Dow Jones starting in 1966, a long 17-year period of wealth confiscation. Do you recognize this stock market? Guess what's happened here? That's right. During those two recent market crashes, wealth was confiscated again. Here is an important lesson, so pay attention. Wealth does not just disappear. Because it is a marketplace, wealth moves someplace or to someone else. That's right. It can be confiscated from you. And the next confiscation is right around the corner. Okay, so here is how your money is confiscated. It's so deceptively simple, it's amazing. The rarely seen chart above shows you what it takes to recover from trading losses. If you sustain a 50% decline, insiders were on the other side of the market and took half your money. Now your money will have to grow 100% just to get back to even. Over the last two market crashes since 2000, 40% of investors' money has been confiscated twice. And this has been going on right under your nose. And you had no clue what happened. Sneaky, eh? That's a lot of years of your financial life they've already confiscated from you. That's an amazing amount of your working income that was once yours. How much farther ahead would you be if you could have avoided both those losses? A massive amount, and years ahead, right? Are you going to let it happen again? I hope not, because the next crash is coming soon. One of the smartest industry insiders ever, John Templeton, profoundly stated, the four most dangerous words in investing are, this time it's different. Well, it's not different this time. The fact is undeniably true. The coming crash is going to be massive. Well, but you're diversified, so you're not worried, right? Not so fast, my friend. Didn't virtually all of your accounts decline and get partially confiscated in 2008? You see, the rules have not changed. You've just never been taught the right ones. It's not only about diversification, it's about correlation. Correlation is how two things move together. +1 means perfect correlation. -1 means opposite correlation. The correlation table below illustrates that mid-cap, international, and small-cap markets go up and down together better than 91% of the time. This is how global insiders confiscate money while you think you're well diversified. To slam home this point, I want to visually show you how correlated multiple country stock markets are to the S&P 500 index. Just take a quick look. At first glance, you would almost think they all were the same markets, but they're not. That is 17 different country stock markets. The top half of each picture is the S&P 500 index. The bottom half of each picture is the country index. Correlation to the U.S. market is an absolute fact. Now you know why Warren Buffett said this. We think diversification as practiced generally makes very little sense for anyone who knows what they are doing. So the first rule is not to lose. The second rule is not to forget the first rule. Look, let's not mince words anymore. Just like all stock market crashes dating back to the 1920s, global Wall Street insiders confiscate boatloads of money. Only this time, global insiders are going to confiscate wealth on a scale unmatched in history. So I hope your advisor will protect you this time and help avoid the years it takes to recover. And by the way, the last people you want to listen to are the media and TV personalities. They are pawns of the global insiders, and they sensationalize the news to make it appear like a sporting event. The media and press always lead you right to where the global insiders want you. They create fear so that you panic and simply buy and hold, even when it is declining and the insiders are confiscating your money. Our research uncovered the third secret insider truth the global Wall Street elite won't teach you. Wealth does not disappear. It simply changes hands between people. It always moves to educated insiders. Volatile market fear is a tool that insiders use to confiscate public wealth. You must avoid massive bear market losses.
Like, holy smokes, how do you stop the bleeding?
The reality of what you've lost is huge.
Right.
I mean, not only have you now lost half of your 401k.
If it took 13 years to accumulate $80,000 and 1 year to lose half of that, and then try to get that back in another 13 years and only be at the $80,000 that you were 13 years ago,
Doesn't work.
the math doesn't work.
I hope you are beginning to realize now that if you were a buy and hold investor through the 2008 crash, you better start thinking hard about a new approach. Because you have serious problems coming very soon. Needless to say, we were amazed that financial advisors are never taught these three truths. But if advisors do know it, we know precisely why they do not teach it to their clients. Now that you understand correlation, let's learn about leverage by looking closer at the same chart. As you can see, we have the three colors here. And right up here on the upper left, you'll see that the SPY has no leverage, which means that the SPY ETF will go up and down precisely with the S&P 500. Now, next to that, you'll see the RYNVX. The RYNVX is the Ridex Nova Fund. And that's a mutual fund you can buy at your discount broker as well. And it goes up and down at 1.5 times leverage. So for example, if the stock market goes up $1, in this particular fund, you should make $1.50, okay? Then there's the ULPIX, which is 2 times leverage, which does the exact same thing, except it makes $2 for every dollar that the stock market goes up. As you can clearly see in the chart, your money can grow much faster in bull markets by combining positive correlation with leverage. You can see the dark line at the bottom, which is the S&P 500, what it grew to. You can see the middle blue line, which is the RYNVX, and what it grew to. And you can see the top green bar and what it grew to. As you can see, leverage helps with proper correlation. Now that we understand the power of combining positive correlation with leverage, let's take a look at a comparative analysis from 2000 through 2016. Let's take a look at 4 different investor personalities to see which one you might align yourself with. There's John, who's essentially an old-fashioned buy and hold investor. Then there's Mary, who is basically buy and hold, but she takes advantage of the entry and exit signals of the wealth preserver, so we call it buy and hold 2.0. Noah's the same. Okay, he's a buy and hold 2.0 type of guy, except he likes to add about 150% leverage. In other words, when the market goes up $1, he goes up $1.50. Okay, then there's Leah, who takes a little bit more risk. Okay, and she buys the ULPIX, which is a Pro Funds 200% leveraged S&P 500 index fund. When the stock market goes up $1, she makes 2. Okay. Okay, let's take a look and compare John and Mary. John, of course, is our traditional buy and hold investor, again, who loves to pay someone else to manage his money, but has not learned about how correlation and leverage work for its benefits. Mary is more or less like John, except she understands correlation, owns the wealth preserver, and follows the red and green arrows. As you can see in the chart below, okay, the red is where John would end up. Okay, and the blue, by following the in and out signals of the wealth preserver, okay, is where Mary would be. So essentially, Mary would have garnered 290% greater profit during the exact same time frame as the buy and hold John did. Noah is also a wealth preserver or buy and hold 2.0 subscriber, and he appreciates a fund that grows 50% faster than the S&P 500 index. So he purchased the RYNVX mutual fund when the wealth preserver gave its green signals. Now there's Leah. Leah is exactly like Noah, except she understands correlation and leverage very well and loves the fact that her money can grow 100% faster than the performance of the index. All of them started with the same 100,000 on January 1, 2000. As you can see in the table below, they all ended up with vastly different amounts. John, who essentially bought and held the S&P 500, ended up with 188,000. Mary, who actually became a Wealth Preserver subscriber or buy and hold 2.0, ended up with 358,000 simply by avoiding the market declines and taking advantage of market rises. Okay? Noah, on the other hand, took advantage by leveraging 150% and purchasing the RYNVX. He ended up with 479,000 to the buy and hold of 188,000 with John. Now, Leah really wanted to take advantage. She purchased the ULPIX, which is a 200% leverage as discussed earlier. She ended up with $605,000 versus $188,000 buy and hold. Only you can determine if you want to take advantage of correlation and leverage to help your money grow faster and cut your time to retirement. Just remember this: Mary, Noah, and Leah follow the exact same wealth preserver. That's the only difference in their ending amount. They got out and in at the exact same time. The only one who didn't was John. All of them started with the same amount on the same day. You now clearly understand how leveraging positive correlation can benefit you. If the markets are going up and multiple different investments go up at the same time, do you want to make more or less? Consider that in your decision. Here are some final thoughts. You've heard the saying that knowledge is power. Well, here's your new knowledge. Correlation plus leverage equals power. Aldous Huxley is one of my favorite brilliant minds of all time, and his quote is perfect for you to think about. Facts do not cease to exist just because they are ignored. Don't ignore them. Take advantage of this, and you stand the chance of cutting your time to retirement substantially.